40 years. That's how long silver has been handcuffed under the same roof. Every time it ran at that roof, the market slammed the door. 1980, rejected. 2011, inches away, then crushed. Decades of rallies that looked real until they weren't. And now in 2025, the unthinkable happened. Silver punched through the $50 ceiling that's been standing since the Reagan era. That is the event. That is the story. A 4-decade lock just snapped. I'm your host, and you're watching the channel where we track the metal moves before the headlines catch up. And if you want the next breakdown the moment it drops, subscribe now. One tap. Done. Because what you're seeing is not another spike. It's not a meme frenzy. It's not a Reddit prank. It's a structural change in a market that most people still think is sleepy, boring, and irrelevant. They're going to tell you this breakout is a fluke. They're going to tell you silver always fails at $50. They're going to tell you you missed it. That's the trap. Because the real story isn't the number on the screen. The real story is what has to happen behind the scenes for a 40-year level to break and hold. To understand why this matters, you need to understand what $50 actually is. It's not just a round number, it's the most infamous scar on silver's entire chart. It's the ghost of 1980, when a historic squeeze pushed silver into legend and then into disaster. It's the memory of 2011, when silver ripped from the teens to the high 40s, and then got hit by a cascade of pressure that looked coordinated because, functionally, it was. And for 4 decades, every major fund, every desk, every algo had the same reflex coded into it. Near $50, sell. That reflex worked until it didn't. This is what people miss about resistance. Resistance isn't magic. It's not a force field. It's a pile of expectations. It's a mountain of orders. It's a wall built out of fear, habit, and old losses. When a market breaks that wall after 40 years, it changes behavior. It rewires the psychology. It flips the story from it can't to it did. And once that switch flips, the next wave isn't driven by hope. It's driven by positioning. Here's the scary part. Most people are still positioned like $50 is unbreakable. That means the squeeze hasn't even started. Now, let's talk about the chart without getting lost in jargon. You don't need to be a technical analyst to understand this. Silver spent decades carving a giant bowl shape, falling for years, stabilizing, and then climbing back to the same ceiling. That's what long-term compression looks like. When price spends that long compressing under one level, it's like a spring being held down with a truck. Eventually, the spring doesn't nudge higher. It launches. This is why breakouts from multi-decade patterns aren't polite. They don't rise in neat stair steps. They gap. They overshoot. They trigger panic. They create headlines that feel surreal. And when people ask, how high can it go? The honest answer is higher than it needs to, because markets don't stop at fair value. They stop at pain. The first pain point is $100. Not because $100 is mystical, because $100 is the moment the public stops calling it a trade and starts calling it a crisis. It's the moment silver becomes dinner table conversation again. It's the moment every producer, every industrial buyer, every hedger realizes they can't ignore it anymore. And if you think that sounds dramatic, ask yourself one simple question. What kind of market breaks a 40-year ceiling and then politely goes back to sleep? It doesn't. So why did this breakout happen now? Not because the internet got excited, not because someone tweeted a chart. It happened because the physical market has been tightening while the paper market kept pretending everything was fine. The evidence is sitting in inventories. Look at what's been happening in China, especially in the visible stockpiles tied to their futures system. The silver sitting in those warehouses has been sliding hard, down toward levels not seen in years. That matters, because warehouses are where reality shows up. A chart can be pushed around by leverage. A warehouse can't be printed. If metal is leaving visible inventory, it means someone is taking it because they need it. And it's not just silver. Gold inventories in the same ecosystem have been shrinking too, falling far below their earlier highs. That combination is rare and telling, because when both metals drain at the same time, you're not watching a fad. You're watching a reset in demand behavior. Metal moves from available to spoken for, from liquid to locked, from price discovery to supply anxiety. And supply anxiety changes everything. Now, let's talk about supply, because this is where the story gets ugly fast. People love to say, if price rises, miners will just produce more. That sentence sounds logical. It's also naive. Mining isn't a factory. It's geology plus bureaucracy plus time. You don't push a button and get a new mine. Even when prices scream, a new project has to survive years of drilling, permitting, financing, building, and commissioning. Best case, you're talking many years from discovery to meaningful production. So if demand surges in the present, supply can't respond in the present. That lag is where bull markets are born. And there's another problem hiding in plain sight. Silver isn't mined like gold. A huge portion of silver supply comes as a byproduct from other metals. That means silver production doesn't always rise just because silver prices rise. If the world needs less lead or zinc, silver byproduct falls even if silver is begging for ounces. So the market can tighten even when silver is expensive, because the supply machine isn't actually a silver machine. It's a byproduct machine. And then people say, fine, we'll recycle. Recycling is the comforting bedtime story everyone tells themselves when the numbers start looking impossible. Here's the reality. Gold recycles well because it's concentrated. Silver is scattered. Silver is used in tiny amounts across billions of products. Your electronics? A dusting. Your solar panel? Spread across a surface. Your industrial components? Thin layers, pastes, films. Recovering that silver is often more costly than the silver is worth, especially when it's embedded in complex assemblies, so it gets trashed, which means a lot of silver isn't stored. It's consumed, gone, not sitting in vaults, not waiting to come back to market. Consumed. And that is why industrial demand matters more for silver than almost any other major metal. Because demand doesn't just move the price, demand can remove the supply. Now let's hit the demand side, because this is the engine nobody can turn off. Start with solar. Modern solar manufacturing still relies heavily on silver because silver conducts electricity the way nothing else does at that performance level. Companies have tried to thrift silver for years, and yes, they've reduced the amount per panel compared to older designs. But here's what the optimists forget. Solar installations are growing so fast that even if silver per panel declines, total silver demand can still rise. Less silver per unit multiplied by a lot more units is still more silver. And the global push to expand solar isn't slowing down. Governments are locked into targets. Utilities are locked into build-outs. Manufacturers are locked into capex plans. That demand doesn't ask permission from the price chart. It shows up with purchase orders. Now add vehicles and electrification. Cars today are rolling computers. Even traditional vehicles use silver in electrical contacts, switches, and control systems. Electric vehicles generally use more because you're adding high-power electronics, inverters, advanced control modules, and more complex wiring architectures. And then you have charging infrastructure, grid upgrades, and power management equipment. Silver is sitting in the nervous system of all of it. Then you pile on the digital economy. Data centers aren't just buildings. They're heat engines. They're machines that turn electricity into compute and heat. And the hardware inside those facilities leans on high-performance electrical pathways and thermal solutions. Silver's conductivity and reliability keep it in the conversation, especially where failure isn't an option. Then there's telecom. Every new layer of connectivity, antennas, boards, transmission components, adds incremental demand. And medical applications haven't disappeared either. Silver's antimicrobial properties keep it relevant in coatings, tools, and specialized materials. This is not speculative demand that vanishes with sentiment. This is demand tied to infrastructure and industrial production. That's why the price can be volatile while the market tightens underneath. It's the classic trap. Paper says, plenty. Factories say, we need delivery. Now here's the accelerant that turns a tight market into a runaway market. Monetary policy. When central banks expand liquidity, commodities feel it. When currency weakens, hard assets respond. And when the biggest central bank on earth starts buying government paper again, even if they slap a new label on it, the market understands what's happening. Liquidity is being added, balance sheets are being supported, and purchasing power is being diluted. That matters for gold. It matters for silver too, because silver sits in a weird, powerful position. It's industrial, but it's also monetary. It's a metal factories need and savers trust. So when the macro backdrop shifts toward debasement, silver doesn't just ride the commodity wave, it rides the money wave. Now, let's layer in the signal that ties the whole precious metals complex together, the gold to silver ratio. This ratio is the market's way of telling you whether silver is cheap or expensive compared to gold. When the ratio is high, silver is being left behind. When the ratio starts falling, it often signals that silver is entering its catch-up phase. And silver's catch-up phases are rarely gentle, because silver is smaller than gold. It's thinner, it's more volatile. It moves like a sports car, while gold moves like a freight train. So when capital rotates into silver, the percentage moves can be violent. What's important is that the ratio has been rolling over from an extreme and breaking important support zones, suggesting that silver is regaining ground. If that continues, silver can outperform gold even if gold keeps rising. And that's how you get eye-watering prices without needing a fantasy narrative. You don't need a miracle. You need mean reversion plus tight supply plus inelastic demand. That's it. Now, take all of this and zoom out. A 40-year breakout isn't just bullish. It's a regime shift. It tells you the market has entered a new chapter where the old ceiling becomes the new floor. That's how big levels work. They don't just reject price, they define it. So if $50 is truly broken, the question becomes, what does the market do with the next decade? Because history doesn't repeat perfectly, but it does rhyme. When long consolidations break, markets don't stop at the breakout line. They discover new territory. They search for where the next big supply of sellers lives. And in silver, the next big psychological shelf is $100. Above that, you're not just dealing with traders. You're dealing with industrial hedgers trying to protect margins. You're dealing with companies trying to secure long-term contracts. You're dealing with investors who are late and emotional. And you're dealing with people who will do anything to avoid admitting they missed the move. That's when the real mania starts. But let's not pretend it's all a straight line. There will be pullbacks. There will be brutal daily swings. There will be headlines designed to shake you out. You will see profit taking. You will see demand destruction. You will see someone on television telling you silver is overbought while the warehouse numbers keep shrinking. Volatility is the weapon. It's not evidence the thesis is wrong. It's evidence the market is fighting over scarce supply. Here's a simple mental model. If silver dips, but the physical market stays tight, the dip is paper. If spot falls, but premiums stay high and delivery delays persist, the dip is paper. If price is weak, but inventories keep draining, the weakness is paper. That doesn't mean price can't drop. Not a headline, not a tweet. Confirmation is a market holding above a level that used to be a guillotine. A true breakout changes the range. It changes what normal is. And if silver spends enough time above $50, the entire conversation changes. Because the people who sold at $49 become the people who chase at $69. That's how markets punish certainty. Now, let me hit you with the question that should keep you up. If silver is breaking out while inventories drain and demand rises, what happens when the next global shock hits? What happens when a supply disruption hits a major producing region? What happens when industrial buyers decide they can't rely on just-in-time metal anymore? What happens when they start stockpiling? Because that is the final boss of this market. A tight market becomes a panic market the moment buyers stop purchasing for today and start purchasing for next year. And once that behavior shifts, there is no smooth repricing. There is only a scramble. This is why $100 silver isn't a meme. It's a logical waypoint in a market that is being forced to reprice scarcity. Now let's address the most common pushback. Okay, but won't high prices reduce demand? In some areas, yes, people might buy less jewelry. Some discretionary uses might shrink, but the core industrial uses are sticky. A manufacturer doesn't redesign an entire product line overnight because an input got expensive. They sign contracts, they pass through costs, they fight for supply, and the silver cost, relative to the value of the end product, is often small enough that the machine keeps running. This is the definition of inelastic demand. And inelastic demand in a tight supply market is how you get vertical moves. Now, I'm going to give you two questions, and I want you to answer them in the comments because this community can spot patterns faster than any single person. First, do you think the real driver of silver's next leg is solar or electrification and grid upgrades? Second, if silver tags $100, what do you think breaks first? Paper pricing credibility or industrial supply chains? Drop your answers below. I read them, and the best points always shape the next breakdown. Now, here's the part most people won't like hearing. The easy phase is over. When silver is quiet, accumulation is comfortable. When silver is loud, accumulation becomes emotional. And when price moves fast, everyone's nervous system gets hijacked. That's when people make mistakes. They chase tops. They sell bottoms. They let volatility convince them the story changed when the story didn't. So your advantage isn't secret information. Your advantage is staying rational while other people panic. And the best way to stay rational is to anchor to reality. Reality is supply. Reality is inventory. Reality is industrial demand. Reality is monetary policy. Reality is the long-term chart that just did something it hasn't done in 40 years. And here's the cliffhanger that matters. If $50 was the ceiling for 4 decades, what is the ceiling now? Because once a market proves it can break a historic level, the next level isn't just a price target. It's a pressure test for the entire system. How much stress can the market handle before it forces new supply, new contracts, new policies, new behavior? Silver isn't just a metal, it's a messenger. It tells you what the world values. It tells you what the currency is doing. It tells you what industry is building. And in 2025, silver just sent the loudest message it's sent since 1980. The ceiling broke. The regime changed, and the next phase is the one most people will only understand after it's already gone. So here's what you do. Stay focused. Stop letting day-to-day noise rent space in your head. Watch the levels, watch the inventory, watch the ratio. And if you want the next episode where we dig into why supply can't ramp fast enough and what that implies for the next move, make sure you're subscribed. Because this isn't the end of the story. It's the beginning of the part that gets uncomfortable. And in markets, uncomfortable is where the money is made.